There's a lot that happened this past week, and so I'm going to give you the highlights so that you're well informed, but also there's also been a lot of hype around what the S&P 500 could actually hit by 2030. So I'm definitely going to give you my thoughts on that. But first, we need to talk about the upcoming tariffs and the earnings reports from some of these very big tech names that happened this week and are gonna happen next week. With an August 1st tariff deadline looming, markets are on edge about renewed trade tensions, particularly with Canada, Mexico, and the EU. At the same time, key earnings from tech giants like Tesla and Alphabet influenced sentiment amidst stretched valuations. Tesla beat Q2 earnings estimates but delivered disappointing guidance. CEO Elon Musk gave cautious commentary on robotaxi timelines, and vehicle deliveries were down 13% year over year into the first half of 2025. Market impact on that was that Tesla shares plunged about 8% on Thursday, but then started to recover strong on Friday. But that did drag down the broader market sentiment, especially within EV and tech-linked sectors. Apple and Google shares rose on optimism, but Tesla's weakness reversed some of those gains. Google specifically, Alphabet reported strong Q2 earnings, driven by accelerating growth in Google Cloud and AI-driven ad revenue. Many question my reasoning as to why I've been investing into Google so heavily since last year. First of all, it's deeply undervalued for what it actually is and the superpower that it actually is when you really look at the numbers. And so right now, I feel like it's been on sale for quite some time. Many think that it's gonna die out because of ChatGPT. Even though ChatGPT is a great tool and is very awesome for search, the business model just isn't there yet, and it actually may never be to the caliber that Alphabet actually has that thing locked down. Google won't die because of ChatGPT, it will evolve. While ChatGPT may eat into certain types of searches like how-tos or definitions or summarization, Google has more money, more distribution, more products, and still leads in critical areas of AI research. If anything, ChatGPT has lit a fire under Google, and competition is accelerating innovation. Google created Transformer architecture, the foundation of ChatGPT. It owns DeepMind, Gemini AI, and pioneered TPU, tensor processing units, for AI workloads. Google's embedding AI into Search, Docs, Gmail, Android, and YouTube. Touchpoints with billions of users. Now, with Google beating its earnings estimates, the market impact was that shares rose about 1%, helping lift the S&P 500 and NASDAQ to record highs amid broader excitement over AI-facing tech stocks. So with the S&P 500 at all-time highs right now, lots of excitement is brewing with big-time analysts suggesting that the S&P 500 will grow big time by 2030. This reminds me of a video that I did about maybe 2.5 years ago about my prediction of where the S&P 500 would be by 2030. So I want to show you a short clip on that, and then show you what those new predictions are showing. This was a very interesting exercise for me to go back in time and to see what I said back then, and the things that I found out were very exciting and should excite you if you're an S&P 500 investor. And now in this clip in this video that I'm going to show you from about 2.5 years ago, I listed the actual value of the index of the S&P 500 with dollar amounts, because in that video I was talking about the S&P 500 itself, the index, but then also VOO or SPY, the different ETFs that actually track the S&P 500. And so when we're talking about the index itself, you shouldn't put a dollar sign in front of it. You shouldn't talk about it in dollars. It'll just be an index like a number with points. Whereas the ETF trades like a stock and has an asset value. And so you are talking about VOO being $500 or something of that nature. So the S&P 500 should just be listed as a number, and I definitely should have edited that a while ago, but I was kind of new to YouTube. Anyway, just don't roast me too bad in the comment section below.
The rule of 72 is a simplified formula that calculates how long it'll take for an investment to double in value based on its rate of return. Basically what you do is you take the number 72 and you divide it by the expected rate of return. So in this case, we can generally expect 10% for the S&P 500. 72 divided by 10 equals 7.2. What this is saying is that it should take 7.2 years to double your money if there's an average of 10% appreciation over that time period. Now let's see if that's actually true, and let's look at prices of the S&P 500 back in history and see what's actually happened. And if I were just to pick one year, I'm sure that I would get accused of cherry picking the best year or something. So what I'm going to do is I'm just going to pick a random group of years, pick 3 different years in a row, average that out, and then pick something 7 years from then, average that out, and let's see what happened. From 1985 to 1987, the average price of the S&P 500 then was $236.74. From 1993 to 1995, the average price then was $484.58. That, my friends, is more than double within a 7-year period. But let's look at another group, maybe one more recent. From 2011 to 2013, the average price was $1,430.35. From 2018 to 2020, remember that 2020 was the year of the coronavirus shock and crazy market plummet. The average for those 3 years was $2,959.14. That's more than double too. So where do I think that the S&P 500 will be around the year 2030? Using the current data that we have right now, I've calculated that the average over the past 3 years, the S&P 500 has been around $4,134. Based off of this, I can confidently say that in 2030 or around that time, I expect the S&P 500 price to be over $8,000.
So when I made that prediction in 2023, the S&P 500 was at about 4,283.73. Today, it's at 6,353.95. So just 2-ish years later, it's up almost 50% from where that was. And if you take a look at the actual comments from that actual video, you'll see that a lot of commenters were actually laughing at me or just saying I'm crazy to think that it's gonna get to 8,000 by 2030. It's looking like we could hit 8,000 by next year at this pace. But let's check out this clip from Adam Parker from about a week ago and listen to where they believe that the S&P 500 will be in 2030.
You know, it sounds like one of those crazy things where it's 6301 and you think, God, 10,000, this is one of these, you know, uber bullish idiots that comes on CNBC type of thing. But when you do the math, long-term S&P's grown earnings about 8.6% per year for the last 50 years. I think it's reasonable to assume that with all the AI investment that's happening, we could get 9 to 11% growth for a few stretch here and get us a little bit above the long-term average. And if you kind of take the price to earnings that we're paying around now, that gets you 2030 on 2031 numbers gets you around 10,000. So it was just to kind of get people. I think the reason the market's been very resilient is because all the investment that happened in AI, we were always told it was going to be kind of a 3 to 4 year before we started seeing it. So one of the things I'm watching, do we start seeing any companies talking about productivity? Microsoft flashed a little last week saying, hey, we save 500 million here. And I think in the next 12 to 18 months, we're going to see more and more of that, and people are going to start thinking, all right, well, earnings can grow 10% in the next couple of years. So we'd be
10,000 by 2030. That sounds crazy, but let's look at the numbers. If over the past 70 years, the S&P 500 has appreciated over 10% on average every single year with dividends reinvested, and right now we're at 6,353, let's just do the math. Add 10%, and by 2026, we should be at 6,988. Add 10%, and by 2027, we should be at 7,687. Add 10%, and by 2028, we should be at 8,455. Add 10%, and by 2029, we should be at 9,301. Add 10%, and by 2030, we should be at 10,231. There you have it. And then real quick, because this guy says exactly what I say when people ask me, why don't you have international or an international ETF within your portfolio? Why are you so heavy on US? And also listen to what he has to say about owning QQQ or heavy growth or tech right now.
Still though, people were looking today at the triple Qs versus the SPY, right? That spread's widening a bit, is it not?
Yeah, I think tech has just so much potential here. In the next 2 or 3 years to grow. I mean, if earnings grow 10% a year the next 2 years, do you want to be negative on tech? I mean, that's kind of how I look at it. Like, I just got back from being in London and talking to a lot of European investors, and I think they look at the U.S. and just think, well, the market's expensive versus its history, margins are high, and I want to own something else. And I kind of want to say, yeah, you know, if you go to you know, any perspective on it. Like I was going to say, if you go to like a Motel 6, it's cheaper than a Four Seasons. Well, it's because it's worse, right? Like you have to adjust for the fact that there's something somewhat inferior about the set of companies that they have there. Here in the U.S., there's just a lot of high margin businesses growing faster. So I don't think it's the end of U.S. exceptionalism. I like the U.S. tech sector. I think the financials are in great shape.
He said it great, and I love this line. The Motel 6 is cheaper than the Four Seasons. Well, that's because the Motel 6 is worse. Be careful not buying something that is a little more expensive than something else, only because it's more expensive than that other thing. Maybe it's more expensive because it has more value. If you don't think AI and tech, especially here in the United States, is going to absolutely explode and continue to grow over these next 5 to 10 years, I'm not sure what I can say to help you out. Anyway, that was very interesting, and it was cool for me to look back at my call from 2.5 years ago and see that my prediction was definitely not way off. It was actually more conservative than where it's actually probably going to be by 2030. So for those of you that laughed at me then, I hope that you at least still just bought into the S&P 500, and now you're very, very happy that you've been investing in it. All right, so what else happened this week? The reason the S&P 500 and the NASDAQ 100 are up so much is mostly from some good news amid trade deal optimism. A new US-Japan trade agreement with 15% tariffs and $550 billion in Japanese investment, plus optimism around a similar US-EU framework. The global investor sentiment improved sharply after that. Hoping to see more of this with this upcoming week in August 1st, this Friday, coming up very soon. This week there was also some growing political risk among the whole Fed uncertainty. There's uncertainty over whether President Trump will retain Fed Chair Powell or replace him prematurely, and that's rattled markets a bit. Analysts warned such a move could cause a 6% drop in the dollar, spikes in Treasury yields, and a broader equity sell-off if it undermines Fed independence. So what do we need to watch this coming week? One of the biggest things on my mind is the earnings. The earnings from major tech names, which could shake broad market sentiment. We already had Alphabet and Tesla this week, but next week we have Microsoft, Meta, Amazon, and Apple. This is the peak week for AI-driven earnings season. Results from these tech giants, especially around AI spend, capital expenditures, and guidance, will likely set the tone for tech sector performance through late summer and early Q3. We obviously need to check on and watch for the Fed developments and Powell's status updates, and then of course the outcome of trade negotiations with the EU, China, and India. That last one is the biggest. I've been telling you all to keep this on your calendar and watch out for not only the actual date of August 1st, but that week before. And that's what we're coming into right now, coming in this next week. Nothing is shaking up the stock market as much as trade talk or as much as tariffs. Recently, there's been a lot of good news, especially like that thing with Japan. And so if we see more of that as we get closer to August 1st, I really think that the amount of good news might just keep the market going steady. I don't think it's going to spike it crazy, but I definitely don't really see too much of a dip. I don't see too much bad news coming out. But I could absolutely be wrong. We could be blindsided. And if that's the case, absolutely, this market will get rocked. So if something like that does happen and you have any money off to the side and you're kind of waiting for that dip, that will be your sign. That will be the time that the dip drops. As we've seen a lot over this year, dips happen, but recoveries happen so quickly. So don't try to wait for it to dip even further. Just get your money invested, especially in the things that you've been researching and the broad, solid ETFs that I talk about here on this channel. I'll be here next week on Saturday to report on the crazy week that I'm sure that we're about to have, and hopefully we have some very good news at that point. So stay tuned in, and for now, watch either of these two videos to keep you going strong in investing, and make sure to keep investing simplified.